stock market will crash. It's happened time and time again. This is the scary truth. However, it doesn't have to be a bad thing. As long as you are properly prepared, you can benefit from the chaos.
I've been investing for more than 35 years, and during that time, I've experienced lots of these crashes. However, I always seem to come out the other side wealthier than before.
So today I want to share the knowledge that has helped me make millions through multiple market crashes. By understanding these strategies, you can spot the warning signs of a crash and use them to your advantage.
So how common is a market crash? Well, there are three different types of market decline. First is the most common type, a market correction. This is defined as at least a 10% drop from a recent high. In 19
It as the stock market realizing it's getting a bit expensive and cutting back prices. On average, these have happened around every 1.2 years since 1980. To the 82's years as like stock market, it has several.
Second most common type of decline is a bear market. You know when you're in a bear market when prices have dropped more than 20%. Since 1932, these bear markets have popped up on average every 4 years and 8 months. One of the person of bear markets often to rate this place by having an plumage.
They tend to keep dragging the market down for about 289 days, or roughly 9.6 months. Sure, that sounds like a long time, but keep in mind that bull markets usually last around 965 days, about 2.6 years.
Third type is a stock market collapse, which I class as an over 30% drop, normally within a very short amount of time. Although these are very uncommon, they can happen. To guard.
The main takeaway from all of this is that if you aren't ready for the stock market to go down sometimes, then you shouldn't be investing in stocks.
How do you spot a market crash? Let's talk about the three phases you need to watch for. Lessons I learned the hard way. First, there's the euphoria. Prices run straight up, fueled by optimism with no ceiling in sight. Then comes the reckoning. Confidence shatters, leverage unwinds, and panic drives a sharp fall. Finally, the phoenix.
I'm not a financial advisor, and this isn't financial advice. I'm just sharing what's worked for me over the years.
Phase 1, the euphoria phase. This is when the market is at its peak and irrational excitement drives prices to unsustainable levels. During this stage, everyone is happy and flying high.
I start seeing this blind happiness. I prepare my investments for when everything comes crashing back to reality. Before the 2008 financial crisis, there were a couple of things I noticed that made me deeply uncomfortable.
First was the boom in consumer spending. Everyone had money, they were spending thousands, and the economy was thriving. A more recent example of this is the NFT craze. Never in a million years would I have thought people would buy JPEG image files for millions.
Things like this are a clear sign of too much money in circulation. The second thing I noticed in 2008 was the increase in people buying houses or refinancing. Because it was easier than ever to get credit. Banks were handing out mortgages like candy, convinced there was no risk. Money kept flowing in a loop.
At the time, a lot of my friends and fellow business owners didn't really understand the decisions I was making. Some of them even thought I was being a little cowardly. But from where I sat, I don't think they could see just how much risk they were charging into. Courage isn't always the loudest voice in the room. Sometimes it's...
If your instincts start tingling, these are some of the things you can do to prepare yourself. First, evaluate and minimize your risk level wherever possible.
I'm not focused on chasing crazy high returns. That's unsustainable for the long term. I just want to be making reasonable gains consistently so my money compounds. I always think of the tortoise and the hare.
New to investing, there's a high chance you haven't experienced a real market crash. It can be horrifying to see your portfolio completely halving in value, so you have to ask yourself, could you mentally handle this? Know yourself before the crash, not during it.
Secondly, I would start to reduce my leverage. Leverage is a great way to accelerate wealth, but it can also be very dangerous. If a stock crashes, your platform may issue a margin call, meaning you have limited time to pay off your debts.
If you don't pay,
Your brokerage may sell your stocks at the bottom of the market to recover the money you borrowed. I've seen too many friends go from millionaire status to broke in a blink of an eye.
I'd start saving extra cash in a high-interest savings account. I know I talk a lot about having an emergency fund, but I'm talking about saving even more on top of that.
The market was booming in 2007, and by leaving money in the bank, I wasn't taking advantage of it. But I noticed more and more people getting interested in investing, which tipped me off that a bubble was forming.
See, when everyone gets comfortable with investing, it can be a sign things are about to pop, because pricing is being propped up by inexperienced investors who, at the first sign of a crash, panic sell, driving prices down further.
Make sure your investments are properly spread out. This is called diversification, and it's one of the best ways to withstand a market crash. Quite simply, don't put all your eggs in one basket.
You have $1,000 to invest. You can put all of that into Tesla hoping it goes to the moon. But if Tesla gets hit hardest in a crash, that's catastrophic. Whereas investing in a total market fund spreads you across multiple industries. Diversified risk.
Phase 2, the reckoning. I like to call this the phase where everyone gets rudely punched in the face with the truth, and only those who know how to navigate it will hold their nerve and make money. When the floor drops out, most people sell in a panic. A few stand their ground. Which side you land on decides.
Even my son knew something was happening in 2008, and he was only 10. The number of customers that came into my hobby stores halved overnight, and even when they did come in, they didn't spend anything.
Bright side, I had warehouses full of products I owned. In 2008, I saw dollar stores opening up everywhere. The perfect mix of demand for cheap goods and supply from failing businesses. In 2008, I saw dollar stores opening up.
Phase 2 is really where you get tested. It's more about human psychology than anything else. Most people's initial reaction is to sell their investments and cut their...
Someone says they're a long-term investor until the market crashes. It's very easy to be long-term when everything's going up. If you believe in your investments, you have to hold firm. To have that belief, you need to understand.
Reminds me of a story Peter Lynch once shared. He bought shares in Kaiser Industries when they dropped significantly. The company had zero debt. Bankruptcy was very unlikely, but the price kept dropping, sliding all the way under $10. He was shocked, yet he held on.
Stock eventually rebounded to $50. The point is, if you don't understand the company, what will you do when the stock keeps dropping? Probably sell and lose out on potential gains.
Applies to index fund investors too. A Fidelity study found that if you invested $10,000 in the S&P 500 from January 1980 to December 2022, you would have over $1 million.
If you sold during crashes and missed just the 5 best trading days, you'd only have $671,000. Miss 50 of the best days, you're down to $76,000. The irony? The best days often happen in the middle of crashes.
In 2008, I went on a buying spree over the next couple of years and acquired lots of different assets, stocks, and even entire businesses. I knew I couldn't time the exact bottom, so I invested every week. This is called dollar cost averaging.
Cash is really king. If you have cash, you can snap up amazing investments during this time. That's why it's super important to keep a steady income and supercharge it with a side hustle during times like these.
While some choose to panic sell and lose all their money, others choose to double down and buy the dip. Done correctly, this could make you a fortune. One lost 40%, one made 300. Same crash.
Phase 3, the Phoenix phase. In this final stage, the market begins to recover and rebuild, rising from the ashes of the crash. It grows stronger, more resilient, and usually pushes above and beyond the last market highs. History shows that bull markets almost always follow bear markets.
I noticed that 4 years after the 2008 crisis, just after the London Olympics, things started to improve. Businesses were hiring, money was a bit easier to come by.
Though people started having cash again, the fear of spending stuck around for a while. Full normal didn't really arrive until about 2016. But by then, those who had invested through the crash were sitting very pretty indeed. Same crash, same starting point, very different endings.
I've been through Black Monday, the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. One key lesson from all of this: a bull market almost always follows a bear market.
Seeds of your fortune are often sown in times of crisis and uncertainty. As long as you can handle your risk level and you're buying consistently with a diversified portfolio, you stand a much better chance than most.
The best investment you can make right now is to start. Whether that's opening the right account, researching your first fund, or simply building that cash cushion, every step counts. Time is your greatest asset.